So what if I told you that right in the middle of the greatest AI bull run in history, one of the most connected, successful billionaires in Silicon Valley just quietly took $74 million out of Apple, Microsoft, and Tesla and basically hid it under his mattress?
Yeah, it definitely forces you to pause, right? When the people who literally helped build the modern tech ecosystem suddenly decide they want absolutely zero part of it, you really have to ask yourself what they're seeing in the market that the rest of us are just missing.
Yeah, exactly. Welcome to today's deep dive, everyone. It is Sunday, March 15th, 2026, and we are unpacking a massive, glaring anomaly on the financial radar today.
We really are. We've got our hands on a fascinating piece of financial analysis that details the recent and honestly pretty drastic market movements of billionaire tech insider Peter Thiel.
And our mission for this deep dive isn't just to track his money. We are trying to figure out if one of the most connected insiders in the entire world knows a historical market crash is imminent, or if he is in the middle of making just a colossal multi-million-dollar blunder.
Right. And doing that requires looking past the flashy headlines. We have to dig into the actual mechanics of his trades, the historical formulas driving this kind of paranoia, and, well, the massive collision course between his defensive strategy and Wall Street's current unbridled obsession with artificial intelligence.
Okay, let's unpack this, because the sheer abruptness of this move is what caught my attention first. I mean, we're looking back at the fourth quarter of 2025. Thiel Macro, which is Peter Thiel's hedge fund, they didn't just trim their positions, they walked completely away from the table.
They absolutely did. Based on their SEC Form 13F filings, which, those are the mandatory quarterly reports that give us a window into what major institutional investors are holding. So Thiel Macro liquidated its entire stock portfolio in Q4 of 2025.
Wow.
Yeah, they sold every single stock. But the mechanism of this exit is what's really crucial here. They reported exactly 0 new trades.
Meaning they didn't sell their tech stocks to go buy, like, utilities or gold or emerging markets. They sold to just go straight to cash.
Correct. And to understand why that's a massive structural signal, you have to think about how a hedge fund operates. I mean, a hedge fund's entire mandate, the reason clients pay them exorbitant fees is to find alpha, to beat the market.
Right.
So if a fund manager goes to cash, they are effectively telling their investors, I cannot find a single attractive opportunity anywhere in the global equities market. It is a complete structural loss of confidence.
And we are not talking about a portfolio of obscure, risky penny stocks here either. In the third quarter of 2025, right before this mass exodus, Thiel Macro had $74 million parked in 3 absolute titans.
Yep.
Tesla, Microsoft, and Apple.
Yeah.
I mean, these are the bedrock companies of almost every retirement account in the country.
Which is exactly what makes the complete abandonment so chilling. It implies this belief that even the safest, most cash-rich monopolies on Earth are currently too toxic to hold.
But I do want to push back on the scale of this for a second, because context does matter. 74 million sounds like lottery money to us. It is a staggering amount of wealth. But for a billionaire like Peter Thiel, who, by the way, co-founded Palantir Technologies and still holds roughly 100 million shares of it, is 74 million really that significant?
That's a good point.
It feels like walking out of the Bellagio, cashing in a few chips you had in your pocket, but leaving your entire bank account sitting on the roulette table with Palantir.
That's a fair distinction, but we have to separate his personal founder holdings from his active macroeconomic strategy. Palantir is his legacy, right? It's his life's work. He's tied to it as a founder. But Thiel Macro is his active reading of the current global economy.
Oh, I see.
Yeah, the $74 million wasn't about ensuring he can pay his rent. It was his active deployable capital. When he pulls that specific lever to 0, it's not about the dollar amount threatening his personal solvency. It's a calculated, philosophical statement that the broader market has become dangerously detached from reality.
Which naturally leads us to the credibility of the guy making that statement. If someone makes a contrarian bet that massive, literally turning their back on the 3 biggest companies in the world, you immediately want to look at their track record.
Oh, absolutely.
Have they done this before? Has this defensive mechanism actually worked for them?
Well, they have done this before. And to understand the gravity of his Q4 2025 exit, we actually have to go back and look at the ghost of 2019. Because in the fourth quarter of 2019, Thiel Macro executed the exact same playbook.
Wait, really? The exact same thing?
The exact same thing. They liquidated every single position in the portfolio and reported 0 new trades. And they maintained that absolute silence for 5 entire years.
Wow, 5 years of just sitting in cash. But the nuance of that 2019 portfolio is critical here, right? Because he wasn't just holding standard stocks back then. He was holding something very specific that kind of changes the context of that sale.
Yes, the mechanics of his 2019 holdings were very, very different. When we look at what he actually sold in late 2019, nearly two-thirds of his portfolio was invested in put options.
Okay, let's break that down for a second.
Sure, so for anyone navigating these terms for the first time, think of a put option as an insurance policy against a stock market crash. You pay a premium for a contract that gives you the right to sell an asset, like the S&P 500, at a specific price.
Right. So if the market tanks, your put option explodes in value. But if the market goes up, the option just expires worthless, and you lose whatever premium you paid.
Exactly. So by liquidating his portfolio in 2019, he wasn't just selling stocks. He was actively canceling his insurance policies on a market crash. He was basically taking his chips off the doomsday square.
And from a risk mitigation standpoint, that was actually a brilliant defensive maneuver. By selling those put options, he avoided massive bleeding losses. Because, as we know, outside of a very brief shock in early 2020, the market did not experience a sustained multi-year crash.
No, it roared higher. He saved an absolute fortune by unwinding those bearish bets before they expired. Worthless.
But defense doesn't win championships if your offense never takes the field. Because while he was sitting safely in cash, avoiding those losses for 5 years, he entirely missed out on the upside. And that upside was historic.
It was astronomical. From the end of 2019 through to the end of 2024, the S&P 500 returned approximately 91%.
Wow.
Yeah, that is an annualized return of 13.8%. Thiel missed every single percentage point of that growth.
And we really have to be specific about what drove that growth, because it wasn't just a slow, steady, predictable economic expansion. He completely sat out the artificial intelligence boom triggered by the release of ChatGPT in the fourth quarter of 2022.
He really did.
He missed the defining technological supercycle of our generation.
What's fascinating here is the fundamental paradox of investing. Sometimes the exact mechanism you use to avoid a catastrophic loss is the very thing that guarantees you miss out on a historic wealth-generating gain.
Yeah, that's such a great way to put it.
He successfully navigated away from losing money on his put options, but the opportunity cost of freezing his strategy for 5 years meant he just sat out a 91% rally.
So his track record is incredibly mixed. I mean, he knows how to avoid a landmine, but he might just sit in the bunker indefinitely while everyone else is outside striking oil.
Right.
Which begs the question for you listening right now. If he sat out a massive 91% gain last time, why should we take his late 2025 exit seriously? Why not just assume his bunker mentality is kicking in again while the rest of the market just keeps climbing?
Because Thiel isn't liquidating just because of a generalized gut feeling or like standard tech fatigue.
Yeah.
If you want to know why he's abandoning ship while everyone else is buying, you have to look at the mathematical formula that is currently terrifying him. He has a historically devastating equation backing up his retreat right now.
The CPE ratio. Let's dig into this because it really is the flashing red siren of this entire analysis.
It is. The cyclically adjusted price-to-earnings ratio, which was developed by Nobel laureate Robert Shiller. To understand why someone like Thiel would sacrifice potential AI gains to go to cash, you really have to understand the mechanics of this metric.
Okay, lay it out for us.
Let's break it down. A traditional price-to-earnings ratio, or PE, looks at a company's stock price compared to its earnings over the last 12 months. It essentially tells you how much you're paying for $1 of a company's current profit.
But the problem with a standard PE ratio is that a single year can be a total fluke, right? Like a company might have a massive one-off tax break, or, I don't know, a global pandemic might temporarily wipe out their supply chain. It's just too noisy.
Precisely. Short-term economic cycles distort the picture. What the CPE ratio does is smooth that noise out. Instead of looking at just 1 year of earnings, it divides the stock price by the average of the company's earnings over the last 10 years. And crucially, it adjusts all of that for inflation.
So it gives you a much clearer long-term picture of whether a stock, or in this case, the entire S&P 500, is genuinely expensive or genuinely cheap, stripped of all the short-term hype.
Exactly. Think of the historical average of the S&P ratio like a rubber band at rest. For the S&P 500, that 30-year average resting point is 28.5. That is cruising altitude. That's normal valuation.
Okay.
But in the fourth quarter of 2025, when Thiel Macro suddenly sold every single stock they owned, the rubber band wasn't resting at 28.5. It was stretched at 39.1.
And it hasn't stopped stretching. I mean, just last month, in February 2026, the S&P 500 TP crept even higher, hitting 39.2. To put that in perspective, apart from these recent months, the S&P 500 has not recorded a KP multiple above 39 since the devastating dot-com crash of the year 2000.
And that is the trigger. When you stretch a rubber band that far, it's not just high, it is storing immense kinetic energy. And historically, market valuations don't just gently relax back to the average.
No, they snap.
Exactly. When they reach these extremes, they violently snap back. The psychological euphoric buying gives way to a reality check on earnings, and the valuation compression is just brutal.
The source material actually included Robert Shiller's historical data for what actually happens to the stock market when the CPE ratio exceeds 39. And the mechanics of this snapback are genuinely shocking.
Oh, the historical data paints a very grim picture of forward returns from this altitude.
Let's walk through these stats because the timeline is what really reveals the danger. Historically, when the CPE ratio breaks 39, here is what happens 1 year out. The best return ever seen is positive 16%. The worst return is negative 28%, and the average return is negative 4%.
Right.
Now, looking at that, I might think, okay, an average of negative 4% after 1 year is rough, but I can hold through that. It's not a complete catastrophe.
It's not a catastrophe if the bleeding stops there. But let's look at year 2. Because valuation corrections are rarely swift. They're a slow realization by the market that it's severely overpaid.
And that's where the floor just falls out. 2 years out, the best historical return drops to positive 8%. The worst return plunges to negative 43%. And the average return over a 2-year period is negative 20%.
At negative 20%, you are in a deep bear market. You are seeing widespread wealth destruction across the board.
Here's where it gets really interesting. And frankly terrifying. Okay, let's look at the 3-year timeline. 3 years after the CPE ratio breaks 39, the worst return on record remains negative 43%. The average return over that 3-year period is negative 30%.
Yep.
But the most alarming statistic in this entire analysis is the best case scenario. The absolute best the market has ever done 3 years out from this valuation is negative 10%, meaning the S&P 500 has never produced a positive 3-year return when its KP ratio exceeds 39.
Never.
Yeah.
That is the exact mathematical reality that Thiel Macro is looking at. Historically, a CAPE over 39 is a singularity where money goes to die.
Wow.
And for you listening, it is really worth pausing to internalize the mechanics of what that means for a real human being.
Yeah.
If the S&P 500's forward returns simply match the historical average from this current valuation, the index will plummet 30% by February 2029. Think about what a 30% aberration of the market over the next 3 years would do to your own long-term financial plans, your retirement trajectory, or like your ability to buy a home. That is the gravity of the situation Thiel is reacting to.
I am really struggling to square this circle, though. If that is a guaranteed mathematical cliff, if history says there is literally a 0% chance of a positive return 3 years from now, why on earth is anyone still buying?
It's a great question.
Why isn't every single fund manager on Wall Street liquidating their Apple and Microsoft stock right next to Peter Thiel?
Because there is a massive, unprecedented new variable in the equation. Wall Street believes the rubber band hasn't stretched to the breaking point. They believe the rubber band itself has been permanently upgraded, and that upgrade is artificial intelligence.
Ah, the wild card that breaks the formula.
Exactly. We have to remember the fundamental mechanism of the KPE ratio. It is a backward-looking metric. It relies entirely on the average of the last 10 years of earnings.
Right.
It inherently assumes that the future economy is going to function somewhat similarly to the past decade. But the core argument of Wall Street right now is that AI adoption isn't just a new product cycle. It is a structural change to the fundamental growth rate of corporate earnings.
Meaning the TPA math is only scary if companies keep making money the old slow way, with the same overhead and the same labor costs. But if AI makes them wildly more efficient, their actual earnings will skyrocket. And suddenly a stock price that looks insanely expensive today will actually turn out to be completely justified, maybe even cheap.
Precisely. And we are already seeing the raw data to support that narrative. It isn't just hype, it's actually showing up on the balance sheets. The source highlights a quote from JP Morgan strategist Kriti Gupta that perfectly encapsulates this mechanism. She noted, and I quote, AI adopters in the S&P 500 have posted margin expansion that outpaces both the index as a whole and the individual companies not using AI by 2 to 3 percentage points.
2 to 3% margin expansion. I mean, on the surface, that sounds like a tiny accounting rounding error.
It does. But applied to the largest companies in the world, it is transformative. Let's explain what margin expansion actually does. It means a company is keeping more profit from every single dollar of revenue it brings in.
Because they're doing more with less.
Exactly. AI is allowing them to automate coding, reduce administrative headcount, and scale their software without proportionally increasing their costs. A 3% margin expansion on Microsoft's massive revenue isn't just an accounting trick. It is the equivalent of generating a Fortune 500 company's worth of free cash flow out of thin air without selling a single extra software license.
That is an incredible way to look at it. You are literally conjuring billions of dollars in pure profit just through operational efficiency. And if you project that compounding efficiency out over the next 3 to 5 years, the historical guardrails of the KP ratio might genuinely not apply.
Which perfectly explains the absolute chasm between Peter Thiel's defensive pessimism and Wall Street's aggressive optimism. They are looking at the exact same market, but Thiel is trusting a century of historical data, while Wall Street is trusting real-time margin growth.
And we can see this tension perfectly when we look at Wall Street's consensus on the exact 3 stocks Thiel dumped: Tesla, Microsoft, and Apple. Let's look at the current targets, because the upside they are projecting is massive. Wall Street's median target for Tesla implies a 22% upside from its current price of $391.
Oh.
Yeah. And for Apple, analysts are projecting a 21% upside from its current $250 share price. But Microsoft is the true battleground here, given their deep structural integration with AI.
The projections for Microsoft are staggering when you consider it's already a multi-trillion-dollar company.
Wow. Right. Microsoft is currently sitting at $396 a share. But among 60 different Wall Street analysts, the median target price is a whopping $600. They are predicting a 51% upside for one of the largest companies on the planet, right at the exact moment Thiel says the market is mathematically guaranteed to crash.
This raises an important question.
Yeah.
Really, the ultimate question of this entire deep dive. Are we currently standing at a unique moment in history where traditional financial models and backward-looking metrics are fundamentally broken by an unprecedented technological leap? Or is the phrase, "this time is different," still the oldest, most dangerous lie in finance?
It is the ultimate staring contest. On one side of the table, you have Peter Thiel and a century of hard historical data screaming that the market is dangerously overvalued. A TEEP ratio over 39 has never resulted in a positive 3-year return. History says the rubber band is going to snap.
And on the other side of the table, you have the collective consensus of Wall Street, armed with real-time data showing that AI is expanding profit margins at a rate that historical models simply cannot account for. They aren't looking at a 30% crash. They are looking at companies generating billions in new free cash flow and projecting 50% growth.
So what does this all mean? We started by looking for the signal in the noise. We have a billionaire tech insider pulling $74 million out of the most successful companies on Earth, fundamentally abandoning his mandate to find growth because the market looks too toxic.
Yep.
We have a historical metric flashing red like it hasn't since the year 2000, and we have a technological revolution that might just rewrite the laws of economic gravity entirely by making companies hyper-efficient.
It really highlights a fundamental tension that exists in every portfolio, regardless of size. You don't need to run a multi-billion-dollar hedge fund to feel the weight of this decision.
No, definitely not.
It is the constant, agonizing battle between protecting what you have built, respecting the historical reality that markets do crash and valuations do matter, and betting on human innovation to overcome those historical limits. Thiel looked at the math and chose protection. Wall Street looked at the margin expansion and is betting on innovation.
And as you navigate your own financial decisions, it is crucial to recognize that both sides have a compelling mechanism-driven case. Thiel successfully avoided the catastrophic potential of 2019, but paid the price by missing out on a 91% return.
Right.
Wall Street is currently riding the massive high of AI efficiency, but they might be willfully ignoring the historical reality that the higher the valuation, the harder the eventual fall. It is a masterclass in the complexity of modern investing.
The data we've explored today shows that extreme caution and extreme optimism are both currently fully justified by different sets of facts. It just depends on whether you trust the long-term history of the numbers or the immediate promise of the technology.
Thank you so much for joining us as we work through this fascinating, multi-layered puzzle today. But before you go, I want to leave you with a final thought to mull over. We spent a lot of time today talking about how the KPE ratio is backward-looking and how AI might render those traditional valuations obsolete by supercharging corporate efficiency.
We did.
But if artificial intelligence truly does make traditional backward-looking metrics like the KPE ratio obsolete, how will we as a society ever be able to recognize a financial bubble before it bursts again.